Hello and welcome to this webinar. My name is Antipasasfor and I'm part of the portfolio management team managing investor accounts here at FxPro. This webinar is aimed at those who are not really familiar with charting analysis. Chart patterns and their analysis may sound like something advanced for many of you. What I want to show you, however, over the next 30 minutes is that this is not the case. Not only is charting straightforward to grasp, it's also a valuable technique that can significantly improve your trading results. Now, why do we care about improving your trading results? Well, unlike the vast majority of online forex companies, we are not a market maker. We operate an agency model and hence we do not profit from your forex losses. Therefore, we are incentivized to help you by building the tools and training you to enable you to become serious and successful traders. Before we begin, please take note of the disclaimer. What it essentially says is that what we will discuss in this webinar should not be seen as investment advice. So I'm not telling you whether to buy or sell any currencies or securities. Now, the reason why we're holding these webinars is for you to learn through our interaction. So make sure you get involved. During the event, if you have a question, please ask in the Q&A window. During the webinar, please keep your questions related to the content I've presented so that we can maintain the flow and keep on topic. I will stop at various points along the way and address any questions, giving you also the chance to ask any final questions at the end. All questions posted in the Q&A will only be seen by me. This webinar is being recorded, but please note that I won't refer to anyone by name and I will answer all of your questions anonymously. Now, in this webinar, you will recognize the significance of charting analysis. We'll learn how to identify an uptrend, a downtrend in the trading range. We'll understand the concept of support and resistance. We'll also become familiar with more complex chart patterns such as double formations, triangles, head and shoulders, flags and pennants. They may all sound like patterns with funny names, but you'll see why they're called so in a few slides time. And we'll also discover how to draw patterns on MT4 charts. So I'll go through some slides and thereafter we'll move on to the actual MT4 platform and show you how you can draw some patterns, identify patterns, etc. Now, why does charting analysis matter? Well, the thing is that so many professional traders and technical analysts who dominate the market expect patterns to materialize, and to some extent these expectations create them in a sort of self-fulfilling prophecy. Now, if you're left out from this knowledge, you may be caught on the wrong end of a trade. The other advantage of charting analysis is that it's based on certain rules that, although require a degree of subjectivity, can help you evaluate risk-reward ratios by identifying entry and exit levels. And more importantly, these levels can help you take profit and stop losses, ensuring you are trading a plan based on thorough analysis. Now, a famous mantra in Forex is that the trend is your friend, and rightly so. The key to profiting in the Forex market is to determine when a trend has begun by drawing trend lines. You then open a position in the direction of the trend, i.e. you go long during an uptrend and you short during a downtrend. And once the trend ends, you close your positions. Now, an uptrend occurs when a security does higher highs. As we can see here, we have a new peak, a higher peak, and thereafter an even higher peak, and higher lows. A trend line can be drawn by connecting two or more lows. Obviously, a line just needs 2 points to be connected, so there are a myriad of trend lines you can draw in a chart. What makes a trend in a trend line stronger is the number of times the trend line has been tested. This increases confidence in that particular trend line. So during an uptrend, you'll connect the higher lows, as is the case here with the troughs, in order to identify the trend line. Trend lines now act as your support or resistance, so they can be an early warning that the trend has come to an end. If you're trading the uptrend and are hence going long, you may want to place trailing stop losses a bit below the trend line. Where exactly depends on your risk tolerance, but if the uptrend line was a good enough reason to make a trade, it should also be a good enough reason to close one as well. Remember, just because an upward trend line has been broken doesn't mean that a downtrend will occur. The break of the trend line simply indicates a change in trend. So it's possible after a sustained up move that we see a period of consolidation with price moving sideways. So what's key here is, once you've identified the trend line, to identify where the trend line break may actually take place, and to set your stop loss during an uptrend, ideally, be just below the trend line, depending on your risk tolerance. Some people may place it below the previous low, so maybe around here. Other people may place it, just a bit below the trend line, just in case there's a small whipsaw, which we'll discuss in just a bit. Now that we've seen what an uptrend looks like, let's review a downtrend. The same logic applies, but here we see lower lows and lower highs. Consequently, the trend line is drawn by connecting the lower highs. Now, whereas in an uptrend the trend line acts as a support line, in the downtrend the trend line acts as a resistance for price. And again, it can be used to place a stop loss when shorting in a downtrend. So we've got here price moving lower, making lower highs as well as lower lows, and when it comes to drawing the trend line, we connect the highs, the lower highs, and this line is a form of resistance. Now, what happens when there is no uptrend or downtrend? Well, in such cases we have a trading range or a neutral area. Although here you have no major trend to trade, you can potentially benefit by placing trades in a trading range with clear support and resistance levels. Support is the line that acts as a price floor, and resistance is the line that acts as a ceiling. So we've got the two lines here. A trading strategy you can employ in such a sideways trend is to short after price has found yet again resistance. So we're finding resistance, so short once you find resistance at the ceiling, placing stop loss a bit above the resistance level. Okay, so it's important to note that just because there's a trend line or a resistance line or whatever, doesn't mean that price will just stop there naturally. Trend lines can be broken. They can be broken viciously, thus creating possibly a new trend, or they can be broken temporarily, as we can see here, with price reverting thereafter towards the average price it was trading previously. In the same manner, you can go long following the hitting of the support, the floor right here, and once price hits support, you can go long, placing your stop loss a few pips away from the support line. Arguably though, the most profitable and reliable trading strategy is that of breakouts. The reason you need to set these stop losses, as we said, in the trading range or wherever, is because a sharp move may occur following the break of a well-tested support level. So we can see here a continuation of the previous chart. Okay, so we look at the Aussie dollar daily, and we had this trading range, and then at some point that trading range ceased to exist, and we had this very strong downtrend you can see here. Now once the floor was broken, we had the breakdown, as those who had gone long prematurely at the support level covered their positions, with others receiving margin calls, thus leading to this very strong downward move. And the reason why breakouts are profitable if traded correctly is because you can place a tight stop loss. Once you have a confirmation of the breakout, the stop loss can be just above your resistance level, and thereafter maybe use a trailing or some other technical analysis pattern in order to identify an exit. You can just keep your position for as long as the trend continues. Unfortunately, despite the profitability and the reliability of breakouts, these are not perfect, and whipsaws or fake outs do occur. So in this example here, price managed to break out from resistance, but this breakout was short-lived. So we can see here we had a breakout, a test of the previous the previous resistance turned into support over here, and thereafter we had the continuation. But this breakout was short-lived. As is usually the case, faked breakouts often do lead to sharp moves in the opposite direction, with price plunging before finding yet again resistance, as was the case here with the red trend line. So we saw here, there was a fake out, a whipsaw, and then price just plunged viciously due to the reversal of the anticipated breakout. Now, if you were an impatient trader, it is likely you shorted at the resistance level, then got a stop loss following the breakout, when you decided to go long, suffering then from the ensuing retracement. So you basically go hit twice. To protect yourself from whipsaws, you may want to apply filters or to breakouts so that you can have some confirmation that the breakout occurred. For instance, you may wait for a close beyond the breakout level, or for maybe a 3-bar move beyond the breakout level, or with equities for a 3% move beyond the breakout level. The choice of the filter is not as significant as consistency in the filter used. Now let's move on to see some notable trading patterns. Double bottoms are one of the simplest formations that form within 2 to 7 weeks. Double bottoms consist of 2 troughs, so 2 bottoms basically, separated by a rebound, with double tops being a mirror image of double bottoms. So double bottoms occur obviously at the bottom of a trend, and double tops are basically 2 hills that occur at the top. When the pattern is completed with a breakout, as was the case here, we can see the white candlestick here, a breakout of the resistance level. It is very accurate despite the throwbacks. Throwbacks are when the trend kind of reverses from the breakout, but you basically usually see a test of the previous support or resistance. So in this case, we had a retest of the resistance level, which we broke out from, and thereafter we had another second throwback close to that level. So you may want to identify as a stop loss level somewhere below the initial resistance level in this case. Now, triangles are another well-known major pattern that is usually a continuation pattern, although somewhat unreliable with regards to the direction. A benefit of triangles is that they can help determine price targets. The price target is derived by the height of the triangle. So we've got here 2 trend lines, okay, that are connected. We've got lower highs, as we can see here, and we also have higher lows. So these 2 trend lines create a triangle you see here, and the price target derived from the triangle is the height of the triangle projected from the breakout point. So we had a breakout here from the triangle, and basically this is what your price target is. Breakouts occur usually half to 3/4 the distance from the base to the apex, to where the lines connect. So if it happens that you see a breakout prematurely or a bit too late, be a bit careful about that. Usually the best triangles and the most reliable ones see breakouts between halfway and 3/4 the way from the base to the apex. Throwbacks also occur on triangles, so they may be a good opportunity to enter or re-enter because you can identify a resistance level at the bottom trend line here, and you can place your stop loss just slightly above that level, so your risk reward ratio can actually be quite good. Now another major pattern, this time reversal pattern, are head and shoulders, both top and bottom. Bottom head and shoulders are called inverse head and shoulders, and the reason why they're called head and shoulders is because they're made up of a head and two shoulders, one shoulder over here, another one here. Now this particular example I have here is a bit of a complex head and shoulders because you have two shoulders, 1, 2, and two right shoulders over here. So two left shoulders and two right shoulders and your head. The good thing about head and shoulders formation is that just like with triangles, you can get some price target. And the price target is derived by projecting the pattern height, i.e. from the neckline, which is this support line you see here, to the high, and thereafter from the breakout level, so you had the break of the neckline to the downwards, basically, in this head and shoulders. The breakout level resides at the neckline, so it's very important that you actually have a confirmation of a break and you don't trade the head and shoulders prematurely. The problem with trading the head and shoulders prematurely, i.e. going short when you're somewhere here, or just a bit too early, is that maybe the pattern doesn't materialize. And what may be the case is, as you can see here, if you were to follow the cursor that I have here, there's a downtrend line. Okay, now if the head and shoulders was not to materialize, you'd have a break of that downward trend line and you would actually have a strong uptrend. So rather than the trend being bearish, it would actually turn bullish with the break of the trend line. So it's important to have some confirmation. We discussed some filters the previous slide. Maybe wait for 3 candles, wait for a daily close, but just find something to be consistent with so that you don't jump into the trade too early. And the other thing important to note with head and shoulders formation is that you frequently get throwbacks, as was the case here. So price broke down from the neckline, and once price broke down, we had a sharp move downwards, and then we found resistance at the neckline during this this pullback before the continuation of the move took place downwards. The neckline is drawn by connecting the lows of the head and shoulders, of the head and shoulders top. So you can see here we've got one low, another low here, other lows here. They're basically what separate the head from the shoulders and the shoulders between them. And this is your support line. Once you break that support line, you can say that you've got some confirmation of a bearish momentum. Now let's move on to some shorter continuation trading patterns. Probably one of the most reliable ones are flags. Again, they're fairly reliable in terms of the price target. The price target here is derived by projecting the flag pole to the breakout price. Now the reason why it's called flag, it's pretty obvious. You basically have a long pole, and you then have downward sloping trend lines, during which we've got some consolidation taking place, and thereafter, we see a breakout and a continuation of the previous trend we saw here. It's usually the case that you've got a steep trend preceding the flag pattern. So there's this area here, there wasn't much activity. Then we had a strong up move, a very strong up move, some consolidation over here, and then once we broke the trend line of the flag, the up move continued. Similar to flags are pennants. Again, they're correction patterns, so you've got a strong move that takes place, as was the case here, you can see, and then then price is moving lower in sort of a small triangle, and once we have a break of that small triangle, then we see a very strong move to the direction of the previous trend. So hence the correction. Price moves lower usually, and then just moves up, with the price target again being similar to that of the flags. Now I'd like to move to an MT4 platform and show you some of these things we have seen in the slide, so that you can learn how to identify them on an actual MT4 platform, and draw the trend lines. Okay, so here we've got an MT4 platform. When it comes to drawing trend lines, you can use over here horizontal lines, trend lines, and you can simply identify trend lines by drawing them at different points. We see here cable had a very strong trend line that held for about a year. It got tested twice, or more like 3 times, at some point before triggering a break, and thereafter we saw this steep down move we've been seeing lately. Trend lines, though, they're not necessarily only used to identify very large trends, very prolonged trends. You can also use trend lines to identify shorter trends. So here I've got Aussie Yen 1 hour chart, and you can see over the past few days there was a strong uptrend in Aussie Yen. Tested quite a few times over here initially, more importantly here. Thereafter, this was fairly close to the trend line, test of the trend line, a test of the trend line, and over here we had a strong break from the trend line. Let me just move this so you can see a bit more, a bit easier, and strong move downwards, and then we had a bit of a throwback with price moving fairly close to where the trend line previously was. So it's important to note that you can actually see a trend line being tested as well, with the break leading to a throwback. Let me also show you another longer term upward sloping trend line. So here we've got Aussie dollar, and let's just move to the candles, and again here this is probably the last trend line, because the thing with trend lines, you can draw them anywhere, and you can initially have it here, here it depends. The initial trend was this one, so you can see that this trend line was actually well tested, and then there was a significant break of the trend line, with thereafter finding some resistance. This trend line here was tested less frequently, but it was basically the last trend line there was here, with testing taking place over here and the previous level over at this level. with price just breaking down. Now, do you see any other pattern on this formation, on this chart? Do you see any other pattern from the ones we discussed? Okay, so some of you are saying there's a head and shoulders. Indeed, one could say that there's a head and shoulders over here. The head being somewhere here, a bit more of a complex head and shoulders with, you know, one shoulder at this level, one shoulder at this, one shoulder over here, one shoulder over there. To be honest with you, you know, this is not a great head and shoulders pattern, but nonetheless, you know, you could see it this way. And given that we had both a trend line break and a possible head and shoulders break take place at more or less the same time, you know, this is the same day actually, we can see a very strong bearish momentum building up, given the significance of, you know, two overlapping support levels being broken. And over here we had a throwback, which again, you know, provided some possible entry signal. Okay, one of the questions is with regard to the triangles and the pennants we discussed previously. How do we differentiate between the two? Let me just move back to that since the slide is here anyway. Now, pennants are small triangles. Triangle formations, though, are much larger patterns. Triangles usually, you know, they take weeks, months to develop. So it's not something that you'd see in a very short time frame. But pennants are, you know, more shorter term, and they can actually develop in you know, just within 2 to 4 weeks or so. So that's your primary difference. It's the time frame you're looking at, and also with pennants, you'd want to see a strong trend just before price moved into that triangle formation. So I hope that answers the question between the difference between the two. Let me move back to the MT4. Now let me show you another pattern, and let's see what you can make of it. Okay, candles. Any ideas what we see here? Okay, most of you got the answer. It's actually a head and shoulders top. So we've got the head here. This is a bit more clear cut head and shoulders. We've got the head here, and over here one shoulder and the second shoulder, with the neckline being, you know, more or less horizontal. Even though, you know, technical analysis and pattern analysis has some objectivity in terms of the rules, unfortunately, you know, you do need to apply some subjectivity in some cases, as is the case over here with, you know, trying to identify the neckline. But you know, here the fact that we've got a spike over here, so a resistance level over here, and thereafter, you know, the support taking place at the same level, so we can see here the spikes more or less at the same level. We can identify this as our neckline, and we see here a break of that neckline. Okay, don't forget we're looking at daily charts here, so these are pretty big moves. You know, 400 pips, and then we had a break of this neckline and the throwback we mentioned previously, and thereafter, following the throwback, continuation of the down move. And we said when it comes to measuring the price target, it's between the height, the high of the head and shoulders pattern, and the neckline. So in this case, around 800 pips. So let's just see how we're faring towards that, and we can see that we've actually exceeded the 800 pips by quite some margin. And when we were to hit the 800 mark, we did see some bounce. This is no exact science, especially when it comes to identifying possible price targets. Others may measure the height of the right shoulder. Others may measure the mid height between the right shoulder and the head, so the place is somewhere around here, and identify this as a price target. It's important in these sort of patterns to use possibly trailing stops, placing them below past support or resistance levels, so that you can potentially lock in some profits. Okay, and over here we've got another trading pattern I was looking at earlier today, and actually did materialize. It's a head and shoulders formation. So we've got here the shoulders, the head, two shoulders, and we had the break of the neckline over here. It actually took place just a few minutes ago. And over here, it's again an important level, the fact that we've got a previous high, which helps us identify a strong resistance level, which gives us some more confidence about entering once we see the break. It's important in head and shoulders patterns to have a strong trend before the head and shoulders formation takes place. So this is a head and shoulders top. It's called the top for a reason. You need to have a trend before that, and the pattern needs to signal the end of that strong trend beforehand. And this was the case in the Euro Aussie. We saw here we had a strong trend, a double top over here as well to some extent, and strong trend, and thereafter the head and shoulders. If there isn't a significant move prior to the formation, then it's unlikely that you actually have a head and shoulders. Strictly speaking, we will actually, if the move prior to the start of the formation isn't at least twice the height of the head, you don't really have a strong trend before the formation. Okay, so let me move now back to the presentation. Okay, so by now, okay, I've got a few questions. If you've got questions, I think now is the time to ask them, so that I can address them now, or just before we end. One of the questions has to do with the time frame. Okay. What time frame should be used to identify a head and shoulders formation, etc., etc. Head and shoulders formations are usually reversal patterns, and reversal patterns take place after a strong trend, so you'd normally have to see it in a larger time frame than a shorter one. Here's the daily one. You basically can't go wrong if you're looking at the daily one. The issue is if you're looking at much smaller patterns, where you may be whipsawed a lot easier, because you're looking at a very small proportion of the trading activity. Whereas if you're looking at the daily, you can actually see months before what the activity was, and you basically have an idea where you are. If you're here, you can see that you've had a huge uptrend, and the neckline build. Whereas if you're looking at a much smaller time frame, you basically have very narrowed vision, and maybe you're not looking at what's taking place beforehand. Nonetheless, head and shoulders formations do take place on smaller time frames. I just showed you one on H1, and in some cases, you can even go smaller than that, M30 or M15. But obviously, the smaller the time frame you use, the smaller the price target that you have, because the move preceding the pattern formation will be much smaller. So the height of the formation will be smaller, and your price target will be smaller. So it's a bit somewhat proportional. With shorter time frames, it's better to actually use look for pennants, flags, which are continuation patterns, which tend to take place during shorter periods. For triangles, double tops, double bottoms, head and shoulders, it's better to look at the big picture, and it also helps you identify whether or not it's a good time to enter a particular trade, because by looking at the big picture and then maybe zooming in and seeing whether there's something else, you've basically analyzed both the recent past and the more historic price action that took place. The presentation will be available on YouTube shortly, so if you're interested, you can watch it again, for those of you asking. Okay, with regards to false breakouts and possible filters that can be used, okay, this is a common issue. Okay, when it comes to seeing breakouts and thereafter seeing a reversal of that breakout, so you basically end up with a whipsaw. The important thing is to have patience. In many cases, you will see a throwback. So you'll see a retest of that important level, and maybe entering then can actually be better in terms of a risk-reward ratio, because you can place a more narrow, a more tight stop loss, and you can catch the trend from the beginning thereafter. Whereas it's possible that you may actually see the breakout. It may be happen that you identified it somewhere here, and you decided to go in, and maybe you didn't want to place your stop loss around there, so you decided to place a much tighter stop loss. So in this case, you basically got hit from the rebound. In other cases, you may want, when it comes to possibly seeing a strong breakout, you may want to place a trailing stop. Depending on the time frame, you'll select the pips that you'll place as a trailing stop, but because the breakout usually leads to a very strong move, if that is the case indeed, and it just happens that the trend stops after 10, 15, 20 or whatever pips, if you do have that trailing, you can possibly lock in some of that profit. So a good example would be, for instance, with dollar yen. I don't know how many of you have been watching dollar yen recently. It's been finding resistance over here at this area, somewhere around 107.30, 107.40. So you can see here, once, twice, downwards, 3 times, 4 times, 5 times, 6 times, with support around 107. So this seems like a scenario where we may end up with a breakout following the break of this level. Obviously, with breakouts, it may help to have some fundamentals that support this, maybe some news announcement, or some expectation regarding macroeconomic policy, because otherwise, you may just end up with some fake gap. But if you were to try and trade the breakout, then ideally you don't want to place your position just above, open your trade just above the break of this level. Let's say the high is here 107.38. If placing the pending or your order at 107.39 or 107.40 is fairly risky, because it can happen that price breaks resistance by a pip, 2 pips, 5 pips, or what may. So you may want to see some confirmation. And other way would be to wait a few candles and see whether actually that was the case. Wait for 3 candles. Now the time frame you look at obviously change how much time you wait, but it's just important to be consistent with these sort of things. And as I said, the other alternative is to wait for a possible retest, because this level here, if we do indeed have a breakout, is likely to act as support thereafter. So once you see price moving lower, then you can possibly enter. Because if you enter now and you enter early, as for instance was the case here, you may actually end up seeing this very fast move in the other direction. So you can see here the candles, when we have a fail of the breakout, we usually do see somewhat steep moves the other way. So let me move back to the presentation. Keep your questions coming. As I said, this is the opportunity for you to advance your knowledge. By now, hopefully, you should know the significance of charting analysis, being able to identify trends, understand what support and resistance levels are, and how you can use them to set take profit and stop loss levels, and be familiarized with various bar chart patterns, being able to draw them on your MT4 platform. Now that you've embarked on this journey to Forex analysis, it's important to get further involved. We have our next webinar on Monday, where you'll gain an understanding of trading psychology, and next Wednesday, not today, the following Wednesday, we shall delve into the world of Japanese candlesticks, seeing how you can use smaller chart patterns as trade signals or confirmations, complementing what you have learned today. And you can sign up for this at our webpage, so FxPro tutorials. So the next one, as I said, is on Monday 22nd, on the psychology of trading with Simon, and thereafter we've got the Japanese candlestick analysis on Wednesday the 24th. And this one is an important one to watch as well, because Japanese candlesticks may help you understand whether you may actually have a breakout or a fake out, because it may be the case that by identifying the candlestick that forms, you can form some expectation about whether the bullish momentum will continue during a breakout, or you'll end up seeing a reversal. You can also learn more by going to the tools and news section and accessing our trading academy. You can read articles and download a lot of material to help you watch videos, etc. This is a very useful resource for any trader. And the most important thing is to practice. Practice makes perfect, and in order for you to practice, just open a demo account and practice safely to see whether or not you're able to identify those patterns we have discussed, and also learn to identify the risk management of those patterns. For those of you asking, the video will become available over the next few days, probably next week or so, and it will be on the YouTube channel. So if you click on FxPro webinars, look at previous webinars, and if you don't find it here, go to FxPro YouTube channel, and you should be able to find it somewhere there. So I think that's it for me. As I said, experience is the best tutor. So if you want to practice these things, MT4 platform is the place to do it, with a demo account to start off with. If you've got any final questions, keep them coming. If you've got any other questions, any problems you experience, any support you need, simply email us at support@fxpro.com or contact us by live chat. We'd be more than happy to hear any webinar ideas you may have at webinar@fxpro.com. I'm Antipas Asfor, Portfolio Management Officer at FxPro. Thank you all for watching.